company. We are being joined by Hareen Kanani, who is the Managing Director of Neogen Chemicals. Hi Hareen, very good morning and thank you so much for your time. First of all, wanted to understand what is the view on the overall demand scenario in the chemical business right now. You did report your earnings, but going ahead for your chemical business, how do you see the industry trends shaping up and which segment is looking the most strong to you right now?
So in chemical industry, especially Neogen is basically serving agro, pharma, engineering industry, and also now we have just started our battery material plant. So these are the four industries that we are serving. So what we have seen as compared to last year, pharma demand has now slowly coming back. Already the specialty pharma was okay. Bulk pharma, there was a bit of a pressure. Lesser demand, so that demand is now coming online. In agro, we are still seeing little bit of we are still seeing the capacity, the demand to basically come in 2025. So the customers are basically saying in 2025 they will have a demand and they will start discussion, or because we make the intermediates, for us it will be second half of 2024. So somewhere around September area, we'll have a more idea on the demand on the agro again. But this year the demand for agro will be a bit slower. But hopefully next year, majority of the demand should be coming back. If I talk of battery materials, we have two segments. One is the international demand. So we see very healthy demand there because a lot of people who are in battery supply chain, because of US Inflation Reduction Act and various additional custom duties which are added, they are looking for a very strongly non-China supply chain. So there's a very strong demand for battery materials there. So our initial capacity, which is just coming online, currently is under approval. But once it's approved by the customers, then we are looking at good demand for our electrolyte salt business. And the Indian electrolyte that we are planning to make, there again the Indian customers are also now getting closer to starting the plant. So as they start their trial productions, we hope the demand for the electrolytes that we make also will increase in coming year and stabilize by next year.
Right. Very good morning to you, Mr. Kanani. This is Cheryl also joining in the conversation. And working capital days have actually increased in FY24 compared to FY23. Could you shed some light on this particular front and how it might actually change in the future?
So, basically last year, so originally when we did our capex in 2023, that's when we had basically set a target to reach full utilization level by FY25-26. So we had already started increasing capacity last year, but then we saw the reduction in demand. So that we had to, recalibrate our plans and make some other molecules and try to shift from the agro-based demand to like more generic India customer base. So because of that change and we were preparing the plant for a higher utilization level when the demand went away. So because of that, we had our working capital was destabilized. But as we guided already in our conference calls, that we feel that by the time this demand recovers and we'll also have full utilization levels by FY26, when our non-battery business will reach almost 1,000 crore plus kind of revenue in the next financial year, the working capital also will get corrected and we should be back to our normal working capital, which is like around 120-125 days of net sales. And then going forward, as we further optimize our molecules, we can further improve upon that. When we talk of our battery business, which is coming online, so this is also, we don't have too many molecules like we have in pharma and agro. It's like lesser number of molecules. So there we expect the working capital requirement to be almost close to 90 days of inventory. So we feel as more battery contribution happens and our full utilization happens, our working capital requirements will improve from FY26 onwards.
All right, Mr. Kanani, since we see that there's a lot of interesting developments in your battery space, can you provide more details on the licensing deal with the NASDAQ listed company that is Nokonoko for the battery separators?
So this is basically Nokonoko is a technology company based in Japan. So they have developed separators which basically will help make cells which can perform in combination with a specific electrolyte design very good at high temperature. So as you know, India is like basically a hot country, and majority of the technology which we are getting in India is coming from Europe, US or China, where the temperature, or Japan, where the temperatures are not so high. So we believe while India will start with first generation cells, which will be based more or less in line with what is international, but then eventually we'll have to have a second generation, third generation cell designs where the performance in Indian conditions will be better. So we believe that these separators which they have developed, they have shown scientifically that they work very well in combination with a specific electrolyte design at high temperature. So we are basically working with all our Indian customers that for your next cell, second generation, third generation cells, why don't you consider using this separator? So right now we are the exclusive distributors. Next 2 or 3 years, we will work with the Indian customers to see if they see the performance and the value in using these separators. And if they see the value, then eventually we can also set up a manufacturing base to make these separators and supply to our customers under contract. So it's, again, right now it's very difficult to predict any revenue coming out of that. It's far-fetched, but we are basically looking at to help get India ready for the second or third generation cells which will improve the performance specifically in India conditions.
Okay, let's put the focus back on the battery chemical business. What's your outlook for that particular business, and when is the production expected to start?
So we've already started in our existing Dahej facility battery, the electrolyte salt of around 400 metric ton and electrolyte roughly around 2000 metric ton. So which can basically support, let's say, around 2 to 4 gigawatt hour of battery production. So that facility phase wise has been starting in last 3 to 4 months. And now we have some of the phases we have also started sending to our customer approval. So the commercial production also is going for approvals to the international customers. And what we feel that during this year, based on the approvals from Q2, Q3, you will start seeing revenue. And by Q4, we should have full optimization or full approvals for the entire capacity. So just that itself is worth around 200-250 crores of revenue. On top of that, additional salt capacity is coming, which will increase the 400 metric ton to 2500 metric ton. So that will also start contributing in the next year. And towards end of next financial year, our greenfield facility for 30 gigawatt hour will also come online. So that will also start contributing. So by FY27, we will have all these capacities available for full utilization levels.
All right, then we leave it there. Mr. Kanani, thank you so much for joining us on ET Now to talk about Neogen Chemicals' way forward going ahead and how the earnings were in the quarter gone by. Thank you so much for joining us on ET Now. And